Hello and welcome to our new series, Greed and Fear. And we are right now experiencing at a bull market like never before. Well, all bull markets, they're correct, but the current bull market has not seen iota of an correction. So where is this bull market headed? This is the best time to invest in India if you are an entrepreneur. The country is on a verge of a strong economic recovery. Globally, the re-rating has started, and given what is happening to China, India's positioning is at an all-time high. But is this a good time for an investor to invest in? Like they say, stock markets are forward-looking. Our market pricing in a lot of the good news which currently is unfolding. What should an investor do? And in this market, where is opportunity, where is fear, where is excess, and where is skepticism? Isn't that investing all about? And to answer all this, I have with me a perfect guest, someone who's seen many bull and bear market cycles. I've admired him for his ability to look at great businesses, sit on those businesses, do not let market noise affect his investment decisions, and see them compound and grow. Raamdeo Agrawal of Motilal Oswal, he joins us now. Mr. Agrawal, fantastic to have you back. Thank you for joining us. We are staring at a bull market like never before. Nobody is complaining, but with each passing day, there are two things which are going higher. Number of stocks at a 52-week high and number of naysayers in the market who are telling us market should come down.
Yeah. So this is a typical phenomena of a bull market, and every bull market has gone through these phases of disbelief, and so this time, thanks to social media and a lot of channels and everything, the noise is a lot more, and structure of the market is fundamentally changed, and that change is what is kind of creating that skepticism look like it is much more than last time. And this change is about the retail revolution, which is on this Robin Hood culture, which is coming in India. But Robin Hood culture is not only about new investors joining, but the floodgates of retail investors who couldn't enter the market for many years, thanks to digitization of the KYC process. Now they are coming in hordes, and so that is fundamentally changing. And till this entry of the retail investors are on for next 2, 3, 4 years, I think we are going to see slightly different type of market. I'm not much more stronger market than what we have seen otherwise in the earlier bull markets, because earlier bull markets happened without retail investors, particularly 2007, 8, and even before COVID. I think retail movement was very weak. Now it is distinctly strong, and that's why you see the bedrock of participation will be different, and how it will show up only time will tell. But in the party, when there are too many people, I think the fun is a lot more.
Fair point. Now let's look at the data, and I'm simply looking at the number of demat accounts which have opened, how millennials have started investing, how technology and app enablement has made people to participate. Some would argue that the new crowd which has invested in the market has not seen a correction. So what happens when the correction kicks in? Because once you feel the heat, you do not want to stand in the kitchen then.
Yeah, correction will happen, and probably if you resist it for long, then corrections can be deeper also. It might look like a mini crash. So it will happen, beyond doubt. I mean, nothing, you cannot defy the natural law of the markets. It will happen. And whatever happens, I mean, of course, a lot of guys will fall by the wayside. There will be nasty experience. IPO market will fizzle out. So those things happen. That's part of the market cycle, and it will happen. So, but you should not be scared of these things. I mean, it's part of the game. What I'm saying is that if it doesn't happen, then it is very amateur. And that's the unease right now, that it has not happened for quite some time. FIs are selling billions of dollars in last 1 week, but still, markets are refusing to bow to their mercy, in the sense that with $1 billion sales, you should be seeing like a blood on the street, but there's no blood on the street. So that's the change I'm saying. And that doesn't mean that correction will not happen. For some other reason, corrections will happen. But that's how it is. Nobody can predict how things will shape up. And this is the only thing I see different compared to other times.
Why are Indian markets outperforming so much? Rarely we've seen this kind of an outperformance. It actually lasts for an extended period of time.
So I think we must have underperformed earlier. It's a churn. I mean, say in 2021 we are doing very well. In 2020 or 19 we must have done very badly. So it's just a reversion to the mean. But if you look at just 6 months or something, we might have outperformed big time. But that doesn't mean that we have done very well on a 3-year or 5-year basis. So markets have their own cycles in terms of when they will outperform, when they'll underperform. But if you look at little longer series, I don't think we are very different from emerging markets or developed markets or things like that.
Mr. Agrawal, if I look at the last 1 year, the gains obviously will look magnified. And if I take your point forward, which is I simply extend the timeline 3 years and 5 years, the market returns are in line with the long-term averages. So can I say that while we can look back and talk about levels of 60,000 on the Sensex and 17,000 on the Nifty, all we've done is that we have simply aligned with the long-term averages?
Yeah, I mean, when I said 50,000 can go to 2 lakhs in 10 years, I mean, it created kind of can it be? I mean, I got a few calls from Delhi. Is it possible? So clearly, I mean, what I'm saying is market will be 4 times. When you say 50,000 to 2 lakhs, nobody tries to see the gap is like 1.5 lakh. But basically it is 4x. And 4x it has done in 20 years, in 10 years, 4x it has done many times. If you analyze the Sensex movement in last 40 years, that is my career in the stock market. 100 has become 60,000. Now that gives me compounded return of 15.5%. Ex dividend. Come dividend is 16.5% or 17%. So if it has given 15.5% on index, so that's what I'm saying. But first decade was 20, second decade was 20, third decade was 30%, and fourth decade was 10%. So what I'm saying is the worst would be about 130,000 and best can be even 3 lakhs. So the middle path, the conservative or maybe the fair estimate, most likely aligning with the long-term average of 15% gives us about 2 lakhs. If it goes to 170, 180 or 210, we have still done well. I mean, basically, how do you see the future? See, because we are walking into the future, we are buying into the future when we buy stocks. So you have some expectations. So what is the expectation? How do we set our expectation? That is what I'm saying. Don't have expectation of outlandish expectation of 2 साल में double हो जाएगा, 3 साल में double हो जाएगा. ये सब कुछ नहीं होने वाला है long term में. Long term, yes, in next 6 months you might get 15%. That doesn't mean that you'll be 10x in 10 years. No, index will never do 10x in 10 years. Very unlikely. And if it does, say like what happens between 90 and 92, that is unprecedented bull run, Nikunj. In 19 months, index went 6x from 700 to 4200, Sensex. And that's why Harshad Mehta bull run is Harshad Mehta bull run. And I don't think that is the kind of thing is going to happen in this market, but you can never say anything. But again, what happened? That 4200 came down to 2500. So it will correct. Market has that correction mechanism. It will correct in a wholesale at one time, or it can correct as you go along every 3 months, 6 months, there will be some correction. But you don't know what will be the pace, what will be the corrections. There will be mini crashes. That's a part of the deal.
When we talk about history, the big variable factor was inflation on one side and interest rate fluctuation on the other side. That is how markets have given the kind of double-digit return what we have. But we are staring at a different environment of excess liquidity and perhaps low interest rates. How does future calculation and assumptions change because of that?
Yeah, so interest rate has played a major role because till 2000 we are talking about more like double digit or say 12, 13%, 14%, 15% used to be in NCD bonds. All the NCDs, they used to get to 15%. That was till 10th century. Then we talked about 10, 12%. Then we talked about 7, 8%. And now corporates are getting money at 400% also. So I think there is unprecedented change in the cost of money. And even the inflation are also moderated in India to more like 5, 6%. So clearly and globally, I mean, now the markets are very global. Europe is at 0 or minus. America is at about 1.5% 10 years paper. And Japan is again flat. So the issue is that in a globalized environment, capital markets are global. The money is pouring in from all over the world. Your forex balance has gone to $650 billion. So your interest rates cannot be very much misaligned. I mean, if the US 10-year is at about 1.5, you can only have 6.5 or 7% as your 10-year paper. So I think if US rates don't go up significantly out of line, then we are looking at 6-7% interest rate for a very long time, and that is a fundamental shift. How do you value the growth? Because this is a growth economy, and if you grow, I mean, you might have heard the chief economist is saying that we will grow for the next decade at 7%. I mean, he expects the economy to grow at about 7% for next 8-10 years. So with 4-5% inflation, you're talking about 12% nominal GDP. And the good corporate, I mean, corporate earnings will grow at 13, 14, 15%. How do you discount? So at 7%, 6% kind of a discount rate, you can see, and the growth of 12 to 15%. So having an index P of 25, 27 is not out of line.
You may not be able to see it, but what we've done is that we've taken some pictures of yours. You'll see them when the show goes on air. Raamdeo Agrawal in his 80s, a picture with Warren Buffett, Raamdeo Agrawal in his 90s, and Raamdeo Agrawal in his current avatar. You've seen 4 market cycles. When you say this bull market cycle is different, what is so different? And I'm using those pictures because just to exhibit that how every time the market cycle changes, you also changed as an investor. I don't think 10 years ago you would have even gone close to investing in a company which was loss making, but now you've invested in Zomato.
Yes, so that's what I'm saying. I'm increasing the circle of competence, and I could be wrong. I'm not saying that I've become master of the game or anything like that. But you have to see, because the growth capex, fundamentally, the growth capex is coming from P&L, not from the balance sheet. So that has to be understood. When you look at the P&L, it is making loss. It doesn't mean that, but in some cases they're actually making losses. What they're saying is that is a scene, and they'll always be making losses. So you have to figure out who are the companies who are showing losses right now, but they have potential to make actually billions of dollars of profit in next 4, 5 years, 6 years. And you have to differentiate between the companies which will never make profit or they'll make very thin profit, and the companies which are actually destined to make a lot of profit, because they are not fundamentally addressing to $3 billion economy, $3 trillion economy. They are addressing to $90 trillion global economy. And that changes the opportunity size for these companies. Now we have to go and see in our due diligence whether these guys are competent and have the business model, they have done the business model which is going to be matching with the expectations.
Okay. Now, if I look at your famous wealth creation study, Infosys, Wipro, Kotak Mahindra Bank, HDFC, time and again, these are the consistent wealth creators. But since you're talking about this digital startup world coming in, hypothetically, if this is the wealth creation study of 2030, do you think the names here would be very different? Because between 2010 and 2020, sir, the number of wealth creators, the names have not changed. It's only the percentages which have changed.
Have changed for sure, but I mean, a lot of new names have come. See, there are 2 categories. One is the largest wealth creators and the fastest wealth creators. So largest have not changed much. I mean, the changes are slower. They have changed, but they are slower. Okay, in the changes. But in the fastest, every time it's a different color. I mean, that reflects the fastest in 5 years. Fastest wealth creating companies are the companies which are flavor of the decade or flavor of the time. So that flavor has been changing. If you go to see the year 2000 study, almost all of them are tech companies. I think 9 out of 10 companies, fastest growing companies were the tech companies. And typically, mortality rate in the fastest wealth creating companies is highest. Because you just can't sustain 200% compounded, 100% compounded for 10 years. So 100% compounded for 5 years will be like 100 times types, So the issue is that level of expansion and valuation is very difficult to justify by the fundamentals. And when people realize that it is not possible, then the things come crashing down. So this is going to repeat in digital companies. I have seen it happened with the soya companies, then it happened with the tech companies, then it happened with the real estate companies, and now this is a time for digital companies.
So, a space where you've invested in the past, Mr. Agrawal, Asian Paints, HUL, Nestle, classic consumer franchise, great ROS companies, they do not raise capital. Now, if one makes a basket of top 3 consumer companies and top 3 consumer tech companies, which basket will create more wealth?
Second one.
Why do you say so?
Because see the opportunity size is so huge. I'm saying 3 global consumer tech companies. I mean, like they're truly digital. So the pace at which they will kind of encompass the whole country or the whole world is not going to be more than 10-15 years. That is not possible with the old consumer companies, because old consumer companies, they have already expanded their distribution, they have already expanded their whatever they can sell, they are doing. So their growth rates are very close to nominal GDP growth rates. So I think they struggle to grow even at nominal GDP. All these names you said, they will grow in double digit growth is like a very aspirational growth, 10 to 12%, 13%, which is basically your nominal GDP growth rates. Even that is being engendered with the help of some kind of a inorganic equation. So these companies are very competent, massive free cash flow, almost 100% of profit is free cash flow. So there's a tremendous, wealth creation or value creation for the shareholders. But these companies are available at 80, 90, 100 p.m. So clearly they'll make a lot of money, as much as these 3 tech companies. But today, I think the growth in the profits from say humble 100 crores or 200 crores to maybe 2,000 crores, 5,000 crores, that will happen in the digital companies, not so much in the old companies. My sense is the old companies will continue to keep doing at 12-15%, where these companies, they will grow at the rate of 40, 50, 60%, and maybe even 100% for a few years, and then operating leverage will kick in, and they will grow a little slower. But I think it is the most exotic time for next 10 years for digital companies.
When one invested in the IT sector, the idea was to buy a software company because the sector did well. But Zomato's business model is different from Nykaa, and Nykaa's business model is going to be very different from Policy Bazaar. You can call them digital company, but how does one understand which is a good digital company?
Yeah, so one of the challenge, Nikunj, with the digital companies, they are different. Every single company is different. None of them are, 2 companies are not same at all. I mean, a Zomato is different from Nykaa, Nykaa is different from some other company. So they're addressing to very niche opportunities. And since they always lead in digital space, very quickly there is a consolidation, even while growth is there. So they're typically going to be 2 or 3 players. It's almost like a winner takes it all in that particular space. So and they're going to be very unique. And right now they will be doing it in India, and they have a potential to go global also. So I think you have to know company level knowledge. Once your framework is clear at how to look at digital companies, then you have to go to the specific company and try to fit that company into that framework and figure out whether it meets your objective or not.
You've run a portfolio which by and large is tilted towards financials, private banks, insurance. The markets are telling you something, that financials are not participating. High growth companies are not going to banks for capital. Ultratech Cement wants to do capex, but they're generating so much of cash flow, they don't go to a bank. Yesterday, the management of Tata Steel was telling me that the cash flow in last 1 year will take requirement of the capex for next 3 years. What happens to financials even the economy is coming back?
No, financials, see, one is that private capex will start. I mean, these are few companies like Tata Steel and all. They will, of course, have a terrific cash flow for a few years, and they don't need bank support. But they are the companies which actually took all the loans in the past, in last 5-7 years. So there will be another segment like infrastructure or cement companies or a lot of consumer companies. And so I don't know from where the loan demand will come. But as economy picks up, see, Nikunj, if as a country, one single point agenda, if we can deliver 7 to 8% growth, like the way China does it, in whatever we do it, once we are able to do that, rest all is taken care of. Because there are not many growth economies of the size of India. Once we start going into about this bank credit, see, $3 trillion, in $3 trillion economy, we have about 110 lakh crores of total credit disbursed, whether it is consumer or whether it is corporate. Now, when we go from $3 to $6 trillion in next 7-8 years, it will require more than 110 lakh crores of credit. It will require more like 150, 160 lakh crores of credit. The composition could be different, but you will require credit. always the economic development is on the back of credit intensity. Credit intensity of incremental next $3 trillion will be far higher. Now, where are the banks which are going to do it? There are only 5-6 banks which can underwrite. And even government is saying, now we want to fold up all the PSU banks into 4 or 5 SBI type of large banks. So 5 PSU banks and 5 private sector banks. So all in all, you'll have 10 banks which will underwrite in next 5 to 6 years, maybe another 110 lakh crores worth of credit, which is a huge opportunity. So, so that migration, value migration from public sector to private sector for the credit dispersal is happening and will happen. And that is what is going to give a massive edge to the banks which can do well.
A theory which you've popularly used is value migration. What is that big theme for value migration for this, for next couple of years?
So today only we will be doing some exercise. So one is, of course, at local level, nothing to beat your value migration in the banks from public sector to private sector. This is the biggest value migration, and only 1/3 has happened in the last 20 years. The licenses started coming in 95, and now it is 25 years of privatization of Indian banking, and that has taken about 30% of the market share of the growing economy. Now the next 30% will happen in next 10 years, and so that the large banks will gain large market shares. So on a 10%, they will gain 10%, that kind of thing. So it will be a huge shift. Of course, percentage will not be that big, but still, on a growth of about 12 to 15% banking growth, you could grow at about 20-25% for larger banks, but the smaller mid-sized bank, they can grow at 25-30% for many years to come. So I think this is a very unique and large opportunity, and that's why you see the Bank Nifty. Bank Nifty has done significantly better in last 10, 15, 20 years compared to your Nifty because of this value migration. Okay. So that is one local value migration. Second, the big one is the tech. The Indian tech from Boston to Bangalore. This migration is the biggest ever has happened in the last 20 years. And I think next 10 years will be the most interesting one. The best is in next 10 years when we will go from $150 billion export to more like $300 to $500 billion of exports. And we are powerhouse, but will become super powerhouse in next 5 years because entire digitization of the global economy. Who are the enablers of digitization? I mean, you see, all the digital transformation is happening. I mean, the platforms are given by, clouds are being given by all these 3 guys, Google, Microsoft, and Amazon, and enablement is happening by our companies. So I think there is and the role of service companies will further increase once they are transferred to the cloud, because then the control of the management will be far lesser. So my sense is this is a golden era for Indian IT. World has become flat because work from anywhere has come. Thanks to COVID, even Americans have realized the world is far more flatter than the way it used to look pre-COVID. Now, you can work from anywhere. Truly, you can work from anywhere. Why should you have 10x differential in the remuneration for the same work? So the world will, as it opens up, it normalizes all the work. Intelligent work will come to intelligent Indians, and hence we will have extraordinary time in next 5 years. And hence my sense is the Indian services companies, they also offer very, very good opportunity to look at.
So I have 3 very quick questions for you. First, about tech. The biggest company in India is about $200 billion. TCS, it's $200 billion. Do you think in this decade, we could have our first 500 billion, not 500 billion, but our first $1 trillion company?
They will have a shot. We'll definitely have a shot. I mean, see, you cannot extrapolate the current business model into the 10 years. There will be change in the business model. They might split up, they might get into products or productized service, or I don't know, they might themselves offer cloud. I don't know what they will do. I cannot think about their business, but the advantage is so massive. They have relationships, they have the low cost, they have the scale, they have the skill, they have the hardworking attitude, very good ethics. Everything is there. I mean, what is not there? And opportunity is global. So, and I don't think the world is going to open up the borders just like that. That visa issues will be there. You cannot send 1 million guys from India to America or Europe. So I think the now the work will come to the competent guys, not to the guys who have the visas. That's what I'm saying.
Last but one question, do you think the way the terminal values of autos are getting compressed, some fear it is because of disruption, some fear it is because of what is happening in the supply chain, is the terminal value destruction short term, and do you see an opportunity in autos?
Yeah, I think it is short term. Yes, I mean the mother of all the value migration is in the EV, IC to EV. So let's not forget that. That IC engine, the conventional engine, is going to give way to electric. Now, I think word is out, and it is no more a lab issue. It is in the commercial world also. Just that affordability is not there at the low end, and the world has to innovate more in terms of battery technology. But it will happen as we go along. Things will become cheaper. It will get scaled up. A lot more innovation will happen. So this journey is going to happen. But I don't think there is a Kodak moment in automotive. I think as things stand today, I think except for Tesla, most of the EVs are going to come from the same bastion of brands. Globally, if you see all of them are about adopting and launching their own electric vehicles. So will happen in India. So my sense is that these companies are compressed because there's a disruption ahead, but that also because the fear of disruption also doesn't allow anybody to enter the segment. But demand is exploding, so the automotive demand, actually we should be very smart in playing this game right now. We should not unnecessarily press for the carbon. See, I think the world has gone crazy. When COVID is hitting the world, they also want to precipitate the carbon decarbonization of the world economy. This is not the time. I mean, if you're talking about 50 years temperature rising, wait for 2 more years. So I mean, you don't have to do it right now. I mean, world is not just sinking. So what I'm saying is, if you don't do it properly, I think world will actually sink. So this is the time to take it easy on the carbonization and actually see that what works for you, what creates jobs for you, what meets the demand. We don't have any penetration. I mean, look at what is the number of cars running on the road. So am I worried about the carbon footprint of 2050, or am I worried about mobility for my people in next 5 years, 10 years? So we have to have a very balanced thinking on this. And it might, if we don't do a good job of this in balancing, I think we'll mess up with the economy itself.
I have so many questions for you, but I know there is a paucity of time. So I'll ask you one final question. You spoke about the number of 22 lakh on the Sensex, and long term we know that we will hit there. But on a scale of 1 to 10, in this bull market, by the time the bull market will peak, 2, 3, 4 years, we don't know, what are the chances that we will end up going close to 1 lakh? Which means in next 4 to 5 years, can we go 50-60% from here?
I can tell you, Nikunj, it will surprise you. It will surprise you. Let's not put numbers to this. How does it mean? It's a journey, I'm telling you. I've done 40 years, I'll do another 40 years. So for me, it doesn't matter whether it goes to 1 lakh or 2 lakh, because I know after 10 years, it will be 2 lakhs only. It might go to 5 lakhs and come back to 2 lakhs, but at the end of 10 years, it will be 2 lakhs only. Because that base rate, the long-term averages of 15, 10, 12%, 12 to 15%, that's not going to be broken at index level. At individual stock level, anything can happen. 10 years is a long history.
Agrawal, I always look forward to our interaction, and I really wish we had more time and we could have covered about so many things, but I'll keep some questions pending for our next interaction. Appreciate your time and thank you for joining us.
Thanks.